Good morning, everyone. Mark Westcott here, Rural Succession Solutions, and today's first of our Q&A sessions for 2024. And today my special guest is Peter McVeigh, and I'd like to welcome Peter. How are you? They're looking very studious this morning. You ready to answer some great questions?
Thank you, Mark. You're always full of compliments, but appreciate you inviting me along to have a chat this morning. It's fantastic. Thank you.
No, and it's a lovely day outside by the look of behind you there. So you've organised a good one for today. There's excited that obviously, Peter, excited that you're the first. You're my first guest on our live Q&A sessions for this year, and obviously, as far as family members go, you've gone straight to the top. So that's an obvious one for you today.
That's what's the cream floats to the top, Mark? Is that right? Is that what they say?
That's right. But look, we've got a few questions today. I'd just like to run past you if you'd just like to give your thought to it. Obviously, as people know, the main thrust of our business is estate and succession planning and associated issues around that for mainly for rural families, not just rural families, but mainly rural families throughout Australia and New Zealand. And one of the most obviously asked questions that I get all the time, Peter, is in regard to families where, mum and dad have been running it for a number of years and they've either got 1, 2 or 3 kids that want to come back and be involved in the farming business. And, you can look at it pretty quickly and work out that that's just not going to work. Even if it's only one son coming to take over, it may be that the farm just doesn't produce enough income. It might be a $10 or a $20 million farm, but there's just not enough income produced each year to look after the son and his family that are coming through to take over the business, and still look after mum and dad in their later years. So, I know we've talked before in workshops and so on about a thing called farm viability. So, do you just want to give your thoughts around how you help people with that and how best to front that if you're in that position? You there, Peter?
Yep, perfect. So it's a bit broken up there. The connection. We've got some issues there, so I apologise for that. But I think, Mark, when we are dealing with our rural-based clients, and particularly in the last 4 or 5 years, we all know that asset prices, farmland has really increased in value, and there's some extraordinary transactions going out there. But it's always been, regardless of that, it's been a thing with rural-based enterprises that they've always been asset rich and somewhat cash poor. So all the asset bases there, they're generally in not obviously not in all cases, but a lot of cases there's not a lot of cash flow in those businesses. So when we come to look at farm succession, that viability of the enterprise to actually work with the transition down to the next generation, if there's even one son who wants to come back on, we're looking at an asset base which essentially has got to support mum and dad, and then mum going forward, the son going forward. So that's critical to have a look at those operations and make sure that the farm does have the ability to support both families, and that's only when there's in cases there's one son. Sometimes there might be as you say 2 or 3, and we've had scenarios where there's 7, right? And you go, well, it's just you can't split the pie up that far and make it viable going forward. So it's critical. The first port of call is to actually say, is it economically viable for the enterprise to actually support 2 families? Because we've got to look after mum and dad, but we've also got to look after the next generation, and we don't want to be putting the next generation under too much stress that they've got to sort of support them and mum and dad as well in the future. So that's one thing that we initially look at with clients, and what sometimes the best solution is, and it's a hard solution because we know there's an inherent connection to the land, and there's sometimes been generations on the land, but sometimes the financial solution, the best financial solution, is to liquidate and split up the asset pool as equitable as possible, and then you can provide a good outcome for mum and dad. They can live a retirement or not work as much going forward. And then at the end of the day, there's still an asset pool then to hand on to the next generation when mum and dad are no longer here as well.
Yeah. Peter, you have a process you take clients through to help evaluate that, don't you? Because obviously, as we all know, in rural situations, there's good years, there's bad years, there's droughts, floods, high prices, low prices for stock and produce and all that sort of stuff. So what do you do to help people from a, dare I say, clinical point of view to be able to sit down and do the sums?
Yeah, we have like a nice handout we get clients to fill out just with details around the performance of the farming enterprise in previous years, the asset base that they have, what the outlook in the future will be. And I know that's a hard thing to predict in farming enterprise with commodity prices and fluctuating weather conditions, but also have a discussion with clients around what their expectation is when they're no longer working full time on the farm, and that's a discussion with mum and dad. What sort of lifestyle do they want to live, and what sort of once again, what sort of income will they need to actually support that lifestyle? And then is the enterprise able to generate that income for mum and dad and also generate an income for the next generation? And so that there's no stress going forward. So one of the critical things is that, when you're finally bearing the fruits of your labours, that you want to enjoy life going forward. You don't want to be sort of beholden to someone to provide that income for you and put everyone under stress and create family conflict going forward, which you've had to deal with, and we've both had to deal with previously, Mark. So it's good. It's critical to have those discussions too. What sort of income requirements you expect, and can the farm generate that?
Yeah, you touched on it, but one of the hardest things, Peter, at the moment is land prices, property prices are so high, and the return on investment, so to speak, is so low for a lot of people that have had farms in the family for years and years and years, and there's just not enough cash there to be able to look after the parents and the next generation coming through. And it is a very hard conversation to be able to sit with people and say, sorry guys, I don't have this conversation, but your best option is to sell. I mean, we were talking to someone the other day who's not everyone's at this level or whatever, but their property was worth effectively $20 million, and they were struggling themselves to make a living, let alone hand it over to the next generation. And just simple maths. I mean, assuming 6%. What 6% of 20 million, Peter? You can work it out better faster than I can.
Yeah.
It's a lot of money. It's more than it's more than $120,000 a year. It's $1.2 million a year, and you've got that income to split around between all the members of the family if you want to, and start providing things for people before retirement rather than waiting until they get there. So. Certainly, is that what you'd use, about 5-6% or something cash rate at the moment?
Yeah, generally we sort of say 5% return, and that keeps pace with inflation as well over the longer term. So when you're investing your capital to provide an income for your longer term, it's not just the income today. It's will that capital keep pace with inflation? So 5%'s a good income amount to base your forecasts on. So that's like that example there, Mark, is a classic example of, will we pass on this $20 million asset, which is eking out an income, which is probably not going to provide a nice lifestyle for all generations going forward, or do we sort of liquidate that? And that is a big psychological barrier to get over if that farm's been in the family for generations. What will great granddad think? Well, great granddad's not thinking a lot because he's not here anymore. But if you can liquidate that and have $20 million in assets, you're generating $1 million in cash a year, which you can spread through the family, and that $20 million will grow over time and still be there when mum and dad are no longer here. So there's a legacy there to pass on as well. It's not sort of I'm selling the farm and it's all gone. There'll be an asset pool there, a quite a substantial asset pool in that example to pass on to the next generation. But as you say, it's that connection to land, which is is the struggle to get over. Like we've joked about it before, Mark, is that my clients that own news agencies, they don't have the issue of, well, I'm going to sell the news agency, retire. We sell it, and the kids go, "Yep, we're selling it," right? So it's that it is a business in a hard sense, in a very mercenary sense, and the more that you look at it as a business and the sustainability of that business, it sort of makes that question a lot easier to do. So that's the discussions that we have.
Okay, that's great. So that's the answer to the question in regard to farm viability. You have a process that people can go through, and you clinically look at the numbers and come back and give them an indication of whether it's viable to keep the farm going or whether they really should look at Plan B. Peter, another question which gets asked occasionally, and certainly it's one we've talked about before, is we use this terminology, silos of wealth, and we're not talking about building a silo and filling it up with grain. We're talking about creating, looking at ways to create off-farm wealth. And look, I was talking to someone as recently as Monday, and I grew up on a farm too, and Dad took every dollar and either bought new land or put up a shed or bought new stock or whatever. So, most farmers, graziers, tend to keep reinvesting in their own properties, in their own real estate or their own properties, stock, and so on, which really creates a problem when it comes to succession planning and retirement, so to speak, because you've got all your eggs in one basket, and it creates some issues. So what are your thoughts in regard to looking at creating off-farm wealth, silos of wealth?
Yeah, I think you hit the nail right on the head there. That last comment, Mark, is that when we're looking at succession planning from a point of view from the financial advisory process, we're always sort of saying like financial flexibility. Like if you've got the financial flexibility to deal with an asset pool which is flexible and not as homogenous as just having all your assets in farming, property and farming business, which from, I suppose, a business sense makes sense when you are growing your business. Most business owners will invest back in the business, and that could be, equipment, and you take advantage of the asset write-offs to do that, and that makes sense. And you buy the next property, and that makes sense. But when it comes to how we're going to divvy up that asset pool, and I've got a son that wants to come back, and I've got a daughter living in Brisbane who doesn't not interested. How do we make that equitable? And I suppose I revert back to clients that we deal with in the South Burnett. So they've had a cattle property long time ago. They started investing in bought units in Harvey Bay, and they had other assets or farm. They've invested in superannuation for tax advantages of that, but also built up an asset pool there. And they've got 2 kids. One son stayed on the farm. The daughter's gone off and established herself in her own profession externally. Lives and works rurally, but not in the South Burnett. And the idea is there that the son will get the farm, and the daughter will get all farm assets, plus that she's been put through university, established a career. She's independently, financially well off, and the son's worked on the farm on the smell of an oily rag as part of that for the last 10 or 15 years. His asset pool will be bigger when we sort of did that plan 10 or 15 years ago. Asset pool is probably about the same, but land prices have increased. But they're all happy with that because it's an equitable outcome. And the only reason they were allowed to provide that solution was because they had built up all farm assets, and that's what we encourage all our rural enterprise-based clients to look at building up all farm assets. And in fact, it's all our small business owners is build up assets outside of the business to provide that flexibility going forward.
Yeah, of course, most definitely. We strike a lot of situations where the farm will get passed down to one child, and there might be 2 or 3 other children, and the child that ends up with the farm, then in a lot of cases, because there's no off-farm assets, they have a financial debt to two, three other siblings, and
Yeah.
even though we give them plenty of time to make that transfer of money to the other siblings. I mean, it might be 5 years, might be 7 years, might be longer if they need it. But the kid that's got the farm is just going to have a noose around their neck for years and years and years, and that in itself can create some issues with their siblings and so on. And if there's bad years and they can't pay the siblings, I mean, siblings have the right to sell up the farm. I mean, is that what everyone wants? So it just makes life so much simpler if you can create those off-farm silos of wealth. Buy some warehouses or whatever, and just make life easier at the end, doesn't it?
Yeah, yeah, and that takes foresight too, Mark. In that, obviously that process you can't start 2 or 3 years before you looking at doing a succession plan and executing that succession plan. That's sort of looking forward 10, 15 years. Like, where do we want to be in our succession plan in 10 and 15 years? And what are we going to do if it's all just farming assets and there's no flexibility for the family to generate an income or farm? Just saying that reminds me of clients that we've dealt with that you referred through to us, Mark, because they do have enough in super to sort of start paying themselves an income from super, and the son is not under that obligation. It doesn't feel obliged to actually make sure the enterprise is generating enough cash for him and mum and dad. Like, mum and dad are separate to it, so it's good from like that flexibility. But as you say, it is an excellent outcome when there's no stress involved around, I've got to make this venture generate X amount of cash, when your inputs are so variable, right? So that's where the pressure comes from.
Yeah, that kind of covers question 3, Peter. So you're an overachiever here today. But the third question was in regard to, an ideal situation. It's nice to be able to create an independent amount of wealth for mum and dad. So when the time comes that they do hand the farm over or hand the business over to the next generation, they actually have enough wealth of their own in retirement assets or whatever to not be putting pressure on the child that's on the farm to maintain their standard of living. So, having said that, that's the way it ends up most of the time. But the times where parents do have their own sort of packet of wealth certainly makes life easier for everyone. So you've answered question 3 already.
Yeah, sorry, I jumped the gun. But I suppose the points around that, Mark, is that obviously any time is the best time to start if you hadn't started planning for it. But looking out in 10 or 15 years' time of where you want to be and start building off farm assets, the beauty of having that time is the actual time, in that compounding returns of your off farm assets will help that asset pool grow without you actually having to do anything with it. So as human nature, or humans are used to just linear returns, like time and compound returns give you logarithmic. So the more time you allow that asset pool to build up, the more substantial it'll be at the end of the day. So if you only sort of think, well, I'll do it in 5 years, you're not going to have the benefit of time to generate that compounding return on your assets externally.
So when someone asks when's the best time to start, Peter, what was it, 5 years ago?
Now, no matter what stage you're at. So,
right.
But you'll be a lot more successful if you've got that 10 or 15 years up your sleeve. That's for sure.
Yeah, no, good answer and good advice. I'm going to touch on something that rural people they don't want to use the words. They don't want to talk about the word retirement. There's no such thing in the rural dictionary, I don't think, the word retirement. And the other word is superannuation. For some reason, the word superannuation seems to have a negative connotation. And, you talk to any grazier and they say, I'd rather invest the money in my own farm, which brings us back to the previous couple of questions we've been going through. But let's talk about some of the tax advantage options. We won't necessarily talk about what their names are, but what are some of the options that people have which really are tax advantaged and really allow mum and dad to create that their separate little silo, so to speak, of wealth for when they do want to go and kick back at the North Coast or just even if they still have a house on the farm and they don't want to leave, it allows them the independence to go travel, do what they want to do, go see what they want to see, and get on with their lives without putting a strain on the property, which most parents really that's their ideal. How do that? What are some things people can do?
Yeah. So we're talking to any clients, and they're rule-based clients, or our small business owners, or our professional clients that building up assets. Like superannuation becomes a very important part of that planning process, and we know that people sort of go, well, super, they change the rules all the time, and I don't like it. My accountant's coming back all the time and saying, I've got to sign this, I've got to sign that. The reason that they're changing the rules all the time is that because it is so very much tax effective. So that and super is just, when you think about it, is just a tax entity. It's not an investment of like equities or property. People generally, they don't have much hands-on experience with super, and just the way that the media talks about it, it's like its own separate asset class. Essentially, it's just like it is a tax entity, like a company is a tax entity, a family trust is a tax entity, you individually a tax entity, and a superannuation as a tax entity just has very low tax rates. So in accumulation phase, it's 15%. When it starts paying out an income to you, it goes to 0%. And that income that goes to you is at 0%. So it's sort of a nonsensical question, is that how long your asset base is going to last if it's taxed at 0% and the income is at 0%, as opposed to holding it in a company which is at 30%. So it makes sense to try to transition assets into that tax environment, which is concessionally taxed. So it's like having a legalised tax haven in Australia, which you're allowed to use. But the government does make it hard to get in there, because that's where all the rules and regulations change. And Anthony, they have to get that money. They will change the time, because they don't have people putting money into it because it's taxed concessionally. And I always say, when the government's trying to stop you from doing something, you should be making critical in that planning stage for when you're no longer working, that you've got a tax-free income and your assets are taxed at 0%. So along the way, there are tax advantages to contributing to superannuation. So each member of the super fund can contribute $27,500 per year and get a tax deduction in their own name. So it's a good tax planning pool in that sense. So instead of having that $27,500 taxed in your own name, you can put it all into super and it's tax free. And then you can also make what we call non-deducted contributions of $110,000 per year, or you can roll that up into $330,000, where you don't get a tax deduction, but you're getting those assets into a tax concession environment. So although the rules change and it can be complicated and you do need advice on it, having assets in super from a planning stage for when you're no longer working is critical, because it just makes sense from a tax purpose, and you have professionals there to give you that advice and look after that process to make it as seamless as possible for you.
Yeah, no, thanks, Peter. Good answer. I just noticed on your screen you've just got Peter, but it's Peter McVeigh. And Peter, you just want to talk about your details of your business, because we haven't done up any fancy slides for you today, so you might want to just talk about where you are.
Cutting back cost of living pressures, Mark. Where the budget slashed.
The inflation rate,
That's right. Yeah. So Peter McVeigh, I've got a rural background myself. Grew up on a farm just outside of John Darien. Went to school in Toowoomba. Been working in financial services for nearly 30 years. Started out in the old days with PIBA, which was the Primary Industry Bank of Australia. So with lending, it's now owned by Rabobank, for been that way for a very long period of time. I'm one of the founders here at Elston. So we established Elston, the precursor to Elston, 22 years ago. We're probably one of the largest privately owned financial services business in Australia, and we manage around all up about $6.8 billion of clients' assets, both on the asset management piece, but the wealth advice piece, and that's around setting your goals and objectives around succession planning, or if it's a small business owner, around when they give up the business, and how the strategies to put in place to make sure that when you are in that stage, you're paying as little as tax as possible, and you've got your investments generating the income to have the lifestyle that you want when you're no longer working full time.
Very good, Peter. That was a very good summary. But I do have one more question before we go. Somebody wrote in and said, my accountant does all this sort of stuff. Why do I need to go to a specialist? And before you even start, it's important to know that at Rural Succession Solutions, we only deal with specialist advisors. I don't believe in the GP approach to anything. But I'd like to give you the chance because a lot of accountants back in the day set up relationships with financial planners, and and having been one years and years ago, I never did it because I always thought it was just a money swapping system for referrals. But maybe you can talk about, Peter, why you think people shouldn't go to their accountant for this sort of advice. They should come to a specialist such as you.
Yeah, thanks, Mark. So we'll have accountants will obviously do the compliance work for your business. They'll do your tax returns, and they're sort of backwards looking. So if you've got a grain operation, cattle, goats, whatever, they'll do your books for that and look after that.
That's good.
Thanks, Mark. Look after sort of the compliance reporting, and as you said there before, Mark, a lot of accountants have branched out into wealth advice or financial planning as a adjunct. For our business, as Mark says, we're just specialists, so we don't do the accounting piece. We just do the wealth advice piece. So, and within that area, we specialise in rural clients. We have a lady in Brisbane. She specialises in family law. So, although we're specialist wealth advisors, we even have specialists down to that. And the difference between using us and an accountant is, I would say, accountants are backwards looking generally. We're forwards looking. So, what have you? What's the reason for you building up this asset, working for 20, 30, sometimes 40 years on the business? You've reached this stage where you want to slow down. What's your life look like going forward? What do you want to achieve when you're no longer working full time? And how do we put in place structures and processes to help you achieve that? And once again, tax effective as possible.
Yep. No, thanks, Peter. So Peter McVeigh at Elston Financial Planners here on the Gold Coast and throughout other areas in Australia as well. But Pete, thanks for your time today. I just wanted to get some of those questions answered, and you did a great job, certainly in regard to farm viability and creating wealth off farm as well. I think are two of the big issues that are very important and part of the whole succession planning process. So Pete, thanks for your time today, and look forward to catching up with you again soon. And to all the listeners, thanks for coming in today and being part of this. Have a great day.
Thanks, everyone.